Okay, hello everybody. This is Mike Durr, the Kingwood Mortgage Guy. Listen, I have scheduled these Tuesday meetings just for people, particularly for first-time home buyers, but for anybody that has questions about the mortgage process, about buying a home, about strategies that'll help you actually save some money. And we find that we can, with just the right strategies just for you, we can save a pot full of money, either money that you keep in your pocket or money that you save by choosing the right loan programs. So there are a lot of reasons to know some of the insights to that and to deal with somebody that's been doing it for a long time. So we're going to get started tonight, and it's going to be the first section. We're going to do 3 sections tonight. Now this is a presentation that it's too long to do in one setting for me. So we're going to do it in a couple different ones. But the first thing we're going to talk about is why do you need to get pre-approved for a mortgage? And the main reason is because of that big, nice house there. I mean, everybody wants to buy a house like that. That is a beautiful house. And guess what? The people that are buying that house, they had to get pre-approved just like anybody else. But here are the key things. What you want to know is you want to know the price range that you qualify for. Now you may or you may not qualify for that $600,000 house, depending on where it's at. But you may qualify for a $200,000 house or a $300,000 house. And until you go through the vetting process, until you go through some of these steps, you're just not going to know. You also, I'm guessing, would like to know what your payment would be. So, and you probably have set some criteria that you want to pay about X number of dollars, okay? Maybe it's $1,200, $1,300, $1,500, $2,000. Doesn't matter what it is, because you really don't know. You might know what the principal and interest adds up to, but then you have to calculate the taxes and the insurance and possibly the mortgage insurance, what all that adds to it. So by getting pre-approved or pre-qualified, you can find out all that stuff. And then how much money will you need? That's a big question. A lot of people, as a matter of fact, the biggest reason that people don't buy houses today, and it's been this way for the last 15 years, is they don't think that they have enough money. A lot of people still believe that it costs 20% before you can buy a house. You've got to have 20% down. Well, that's just not the case. Another big reason is the only chance a realtor will work with you if you haven't been pre-approved or pre-qualified. They're really not interested in taking you around to look at houses when you can't really buy. I mean, unless you have a pre-approval letter, you've had your credit pulled, you've had your information vetted, then really the realtor is going to direct you to a lender. And so it's a good idea to do that early. So what do you need to do right now? This is another thing, and the reason I put this one here is a lot of times you may not be quite ready. You may be close, but you may not be just ready to do this. But by doing this, it opens up the parameters of what you need to do, what the next steps are. And it happens all the time that your credit score may be off just a little bit and you need to raise it up. And that's an opportunity for me to come in there and give you some real quick advice on what you need to do to get your credit score up. And it could be that within 30 days, your credit score is good so that you can buy immediately. However, if you hadn't come in to get pre-qualified, then you're not going to know that. So you're just going to flounder out there, still wondering. And so it's critical that you just kind of get in and you go, you know what, I just need to find out where I'm at. And there are a lot of people like that, and I think a lot of people get pleasantly surprised. And then the big one in this market, and it's been this way for the last 2 years, I don't know if it's going to stay that way, but you got a much better chance, well, you have no chance of getting your offer accepted if you don't have a pre-approval letter. I mean, that's the one thing. Sellers are pretty savvy today, and many times they're getting more than one offer. So if you have a pre-approval letter, that gives you your best chance of getting your offer accepted. And in this market, that's a big deal. So there are some pretty good reasons as to why you need to get pre-approved. Now we're going to talk about the ingredients of your financial profile and what a mortgage lender is looking for so that they can determine whether you are going to be pre-approved. So the first thing they're going to do is they're going to ask you for some items. First item they're going to ask for is paycheck stubs. And the paycheck stubs usually are a good indication of what your income is. Now, not everybody's paycheck is the same, but most paychecks have year-to-date income. They have the hourly wage in many times, and they extend if there's bonuses, if there's commissions, if there's overtime. So all those things are very important for us to know. We're also going to ask you for 2 months bank statements. And the 2 months bank statements, the reason we do that is that we want to know that you've got assets, at least enough assets for the down payment and, of course, any closing costs that might pertain to the loan. Additionally, we're going to ask for 2 years tax returns, W-2s, and or 1099s. Again, this gives us a good idea of the consistency of your income, that you've got stable income. It's been consistent, and hopefully it's consistent and it's increasing. Now the next one's a big one, is we're going to look at your debts. So we want to look at your income compared to your debts. We're going to need to pull your credit. It's real important that we pull your credit. And the credit scores and your history, your credit history, are important. But also, the thing I didn't list on here is we need to take an application. And the application is going to ask you for a 2-year work history. It's going to ask for a 2-year address history. And all of those things we're going to put into this loan application, and it's going to tell a story. The biggest thing, if you clear the stability of the income and you have decent credit, then it's going to look for things that kind of tie it together, and then it's going to put a number on the debt ratios. Now, the debt ratios are a big part of qualifying, and each loan program out there has specific debt ratios that you have to fall within. If you go over the debt ratios, guess what? You may qualify, you just may qualify for less house than what you may have anticipated. If you have high debt and low income, then guess what? It's going to be hard for you. But if you have little debt, you can still have low income, and you'd be surprised that the qualifying is pretty aggressive because the ratios are pretty comfortable. You may not understand what I'm saying when I say they're comfortable, but they allow for you to qualify for a lot of house. Matter of fact, a lot of people qualify for a lot more house than they're comfortable in paying the mortgage payment. So that's just something to think about. But you know what? The bottom line is, until you go in for the pre-qualification and you go through this exercise, then you really just don't know anything. And what I'm encouraging you to do is to find out. Okay, so we're talking about credit scores, and what I wanted to do is I wanted to go through these couple slides here, and it's just kind of a general thing, but I'm going to get it a little more specific. So what it says here is that 760 to 850 is excellent credit. Anywhere you slice it, those are fantastic scores. From 700 to 759 is very good. From 723, and there's probably a number there, I guess it would be, it looks like that one should, that's actually a messed up slide. So I don't know what it could be. This is probably 740, and this is 720 to 740. So I'll fix that slide. And then 660 to 699 is good. And there's another one. 687 is average. This evidently is the average of what most people's score is. And then you got 620 to 659. According to this chart, it says that's not good. And if you're 580 to 619, that's poor. And if you're 500 to 579, that's very poor. Now, this is not my slide. This is a slide that was posted on the internet. And this is an indication of what a lot of people get. Now, you're going to see in these next two slides a little bit of a different story. So let's go to this one. What I put on this one is the FHA Credit Risk Score graph. And what this one talks about is the real scores that you can get a loan with. And so, I didn't want to do that. Okay, so if you have a 680 to 699, or anything above, I probably should have said 680 and up, could be 680 to 850. The FHA considers that no risk at all. And then you just go down the line. At 660, it's considered a slight risk. At 640, a small risk. And when I say risk, what I'm talking about is a risk that you might not pay, or it might go 90 days until you get a payment or they get a payment. So this is the lenders looking at these scores and going, this is a small risk, this is a slight risk, there's no risk here. Medium risk, the 620 to 639 is considered a medium risk. The 600 to 619 is a real risk. And then they actually have programs where if you're below 600, 580 to 599, under certain circumstances, you can still get an FHA loan. So I think that that's kind of interesting, and that should give some of you hope. Now, what I'm going to do on the next one, this is a conventional credit score risk graph, and it's different than the FHA. And you can see the 740 to 850, they consider that no risk. Matter of fact, there are no hits to your rate under this circumstance. 720 to 730, it's a slight risk, but you get a minor hit to the rate, but not a big one. The 700 to 719, small risk. Again, there's another hit that you would get on your score here. 680 to 699 is a medium risk. And then 660 to 679, the risk relate, this is a risk, and it also is a higher interest rate because there's more risk. So the more risk there is, the higher the interest rate is. Now that doesn't mean that they're not going to make you a loan. They're just going to charge you higher for it because it's more of a risk to the investor. And then down here, there are certain conventional programs that are from 620 to 659 that under the right circumstances, under specific guidelines where the property meets a certain criteria and the borrower's income meets a certain criteria, the ratios have to be just right. There are loans on the conventional world that do qualify in these lower FICO ranges. So I thought that was interesting. So what happens is we take this information from here, these guys, and we review it. We plug it into our application. We calculate the monthly income. We calculate the assets you've got. We do any math that's needed to do on the W-2s and the 1099s and returns. And then we add the debts in there so that we can get a debt ratio. And then we come up with an approval. So your paperwork's reviewed. Then we're going to see if there's any loan programs out there that would benefit you. And you see that these are primarily the ones that we look at. FHA, USDA is a very good program, Fannie Mae, Freddie Mac, and then the VA. So between these groups, this pretty much, unless you're talking about a jumbo loan, which is a non-conforming loan, these would definitely be the 5 areas that we would look for to see if any of them fit the criteria that you meet. going to be a